Namaste to all. I welcome you all on another interesting webcast, a panel discussion on a very important subject, which is, I would say, I normally say that it is in the bloods of the chartered accountants, that is income tax. But today it is not about income tax, but it is about accounting about income tax. And we talk about accounting of income tax. It could be current tax, it could be deferred tax. And what are the standards related to that? When it's to be accounted, what is the disclosures, all that we'll be discussing today. And for that, we have got two panelists out here, C. Adesh Sharma and C. Nilesh Khemka ji. C. Adesh Sharma ji is having more than 10 years of experience and has been a regular contributor in the INDES programs and the accounting standard programs and regular faculty to our institute. And
Hello.
Namaste. Welcome to you. We also have CA Nilesh Khemka ji, another young panelist today. It is always bright to see young panelists because that inspires others too. So he's also having more than 9 years of experience and also a regular faculty to our INDES course by the accounting standard course. Earlier it was an implementation committee, but now it is through the ASP. So we all are looking forward to a great discussion with both of you. And
Namaste.
to moderate, Namaste, welcome. And to moderate, both of you, we have got a young and energetic chartered accountant, CA Nitika Khewani ji, who is also the special invitee to our board. I'll request Nitika ji to please take over and moderate the session from here.
Hello and good evening to all. To set the pace of the session, I would first ask Pramod sir to please tell us which standards provide for accounting for income tax under AS, Ind AS and ICDS.
Yeah. Before I start, our young and energetic vice chairperson, C. Abhay Chhajed ji, the first time he has come to the council from a city of Bhopal, which is very heartening for all of us. So I'll request his initial comments before we are able to start the discussion.
Thank you very much, Pramodji, the chairman of the Accounting Standard Board, and thanks for giving me this opportunity. Of course, it's always a privilege and honor to speak among the members, and I also welcome on behalf of ASB, Nileshji, Adeshji, who are the panelists today. And,
Thank you.
Thank you so much for sparing your valuable time. And of course, Nikita will be moderating, and thank you on behalf of ASB and my ASB team who've taken this initiative for regularly, in fact, not just this webinar, but we've been doing this regular webinars in the best interest of members participating in this very important webinar on accounting on income taxes. And Pramodji is, always been very instrumental, and he himself is a very, I would say, learned, and it's an opportunity to work under him, he being the chairman, and I have given an opportunity to be the vice chairman of the Accounting Standard Board. It's a great opportunity with the knowledge and, the wisdom he carries and the way he deals with things. And thank you so much, Pramodji, and always encouraging for whatever events, activities we do under ASB. And this is one of the examples which we have today. And we also have launched our website of ASB. If I'm not sure whether Pramodji has mentioned, but I would just like to add, because I joined late, sorry about it. But we have launched our website of asb.ici.org, and very important. And I think it would not just be, would have the educational materials. Of course, those are there already there in the wall and the institute website. But what we are trying to do more here is that every Ind AS, every standard accounting standards which is there, we are trying to, have a linking with each of these Ind AS and AS, so that if you are reading any accounting standard which has a reference of any other accounting standard, you would be able to, quickly link to the other standard also. So there would be linking of these standards within the standards and also in the Ind AS. So I think that would be really helpful to the members, that they could find quick links, quick paragraphs, quick relevant material which they are looking at. and also together at one place, rather than looking at these accounting standards separately or Ind AS separately. So, and this again is the initiative of our chairman, and of course I am assisting, and definitely will try to do this before end of 30th, before this June end, so that it's made available to members and they can use them more, particularly in terms of doing the financial statements and completing the audit well within the time, and make use of these accounting standards and Ind AS. And today the important topic, and I congratulate both these speakers, the panelists. Thank you so much once again. And we would have question answers which would be coming from the participants, and we would be very happy, and the panelists would to respond whatever best we could till the time available. And in case there are any questions unattended, and we'll surely ensure those are responded or sent over mail back to the members who has this query, asking the experts to respond, and then we'll in turn send it in quick time. So thank you so much, Pramodji, for this opportunity, and welcome all of you once again for this webinar.
Thank you, Abhay, for the very kind words, and he being very modest. In fact, he is leading the ASB in a very, very high spirit, to be very frank, and recently one of the publications where his contribution is immense, and our another council member, Vishal Doshi's contribution is immense in relation to the formats for the financial statements of the non-corporates. So that is really a great work, I would say, of Abhayji and Vishalji. And here, just to tell all the participants out there, wherever you have to audit a financial statement of a non-corporate, say a proprietorship, partnership, or anyone, please use those format only and comment on their own, because it is available on the website of asb.ici.org as well as the ICI page. It is there. So kindly use that. Now coming back to the question which Nitika asked, if we talk about AS, everyone I suppose know that it is AS 22, which talk about the deferred taxes, and in case of Ind AS, there is Ind AS 12, which talks about accounting for the taxes, income tax. And if we talk about Ind AS, talk about ICDS. ICDS does not have any standard, because that itself, ICDS is under the Income Tax Act. They say whether you account or not, you just pay the tax to us for the taxes if they talk about. So in that case, ICDS are only 10, and it does not talk about the income tax. So these are the basic. I just initially what are the standard numbers? One of the questions one of the participants asked also, what is the standard for the Ind AS for the accounting for income tax, and that is Ind AS 12.
Moving on to next question, Adeshji, would you like to tell us what is different between Ind AS 12 and IAS 12?
Yeah, hello everyone. So once we adopted Ind AS under India, so basically we adopted Ind AS as it is from the IAS. I mean, in few of the standard you will see that there are carve-outs available, but if I talk from the perspective of Ind AS 12, so there is no carve-out, and Ind AS 12 is aligned with IAS 12.
So this is one of the. This is just to add, this is one of the standards where there is no carve-outs.
Right.
And it is verbatim same as the IFRS foundation, IFRS standards, that is IAS 12.
Right.
Pramod sir, as AS 22 are applicable to non-corporates also?
Nitika, this is very important. And sometimes we see that our members miss out on that. They say that how an accounting standard is applicable to a non-corporate proprietorship partnership. But the fact is, yes, they are mandatory, especially on the auditors who do the audit. They have to ensure that the accounting standards are really complied with. And then in that case, yes, all accounting standards, including whatever the exemptions are given, that is separate, including this AS 22, we talk about the deferred taxes. Here, when the non-corporates, they are divided into 4 levels, level 1, 2, 3, 4. So an exemption has been given to level 4. Level 4 is the entity whose turnover is less than 10 crores. So in that case, they have an exemption given that whose turnover is less than 10 crores to only provide for current tax and not the deferred tax. So Friends, please take care that we have to provide for the current tax in all cases. In case the current tax is not provided for, in that case, the auditor should give a qualification that AS 22 has not been compliant with. In case of other than level 4 entities, proprietorship, partnership, or LLPs or anyone else, so all others have to also provide for deferred tax. Now, in the case of proprietorship, partnership, LLP, say what is the deferred tax? There is no depreciation difference. But yes, there could be 40 AIA, there could be 43B, there could be carry forward losses. There could be so many. The difference between the book profit and the tax profit. So timing difference is there. So in that case, even in the case of proprietorship and partnerships, you have to provide for the current tax as well as the deferred tax. Please take care of the same. Thank you.
Nilesh ji, what are the fundamental differences between AS 22 and in AS 12? Or is it just the title of the standards that is different?
Okay. So between accounting standard 22 and Ind AS 12, it's not just the title. So we have many fundamental differences per se, like disclosures. There are certain transactions for which we were not having guidance under accounting standard 22. Plus, fundamentally, there is a change how we calculated or we calculate deferred tax in accounting standards and how we calculate deferred tax in Ind AS. So moving from starting from the approaches for deferred tax, Ind AS 12 talks about balance sheet approach. So here the focus is on the timing differences or the temporary differences between the book base and the tax base of a particular item of asset or liability. Under Ind AS 12, we first calculate the balance of deferred tax asset or liability as at the reporting date, and then we calculate the deferred tax expense stroke income by deducting from the previous recorded balance of deferred tax asset or liability. Whereas if we talk about accounting standard 22, it follows income statement approach, wherein we compare the accounting profit vis-a-vis to tax profit, and we create deferred tax asset or liability as appropriate, where we find any timing differences. In case of accounting standard 22, we first calculate depreciation expense stroke income, and then we eventually arrive at the deferred tax asset or liability as at the reporting days. So this was the starting point, the major difference in the approach of these two standards. Second, I would say there is a difference where we have certain items which directly hit into the equity reserves or any other reserves or the other comprehensive income part. So there was no specific guidance under accounting standard, or there is no specific guidance because we don't have like OCI section there. Ind AS 12 says primarily all the deferred tax expense or income part should be recognized in a statement of profit and loss. However, if any particular item is being recognized in other comprehensive income or directly into the reserves, then related deferred tax should also be recognized over there itself. So one example which most of the members would be familiar is remeasurement gain loss on the gratuity. So we need to present the actuarial gain or loss in the OCI section, and so as the related deferred tax. Then we have the guidance on tax holiday, which is available under accounting standard 22, but we don't have the similar guidance or related accounting implications under Ind AS 12, though we are drawing inference from accounting standard only. Then entity which has carry forward tax losses or unabsorbed depreciation or unused tax credits, right? Accounting standard 22 says there has to be virtual certainty with convincing evidence, whereas Ind AS 12 says probability approach. So insofar as related to these recognition of deferred tax on unused tax losses or unabsorbed depreciation, AS22 is or AS22 has stringent conditions, whereas in AS12 just we need to be ensure like there is a probability sufficient taxable profit will be there in future, and we can recognize deferred tax based on that. Whereas we need to have or we need to support the recognition of deferred tax asset by virtue of the virtual certainty and the convincing evidence over there. Then one major difference is the functional currency assessment. So there is no concept of functional currency in accounting standard, and accordingly there is no guidance. But let's assume a company has a functional currency of USD, right? Now, when the company will convert their accounting base or tax base, so tax base will remain in INR. When they convert their non-monetary assets and liabilities, there arise a temporary difference due to change in the exchange rates. So deferred tax asset or liability needs to be created in that case. Then we have some disclosures which are coming up or new disclosures coming up in Ind AS 12 which are not required in AS 22 like reconciliations and then we have the expiry of tax losses, etc., which I think we will discuss in detail going forward. So these are the differences, which major differences between accounting standard 22 and Ind AS 12.
Now here, just to add one question was has been asked by one of the participants, Amit Sarabji, regarding the financial statement for a non-corporate. So I'm taking just that right now. That whether where is the requirement to disclose the previous year figures in the case of proprietorship partnership? Where is the law? Which is the guidance? Yes, first of all, that is given in this technical guide which we have come on. But secondly, please take care. There is a framework for the presentation of financial statements, which is issued by ICI and which is mandatory for all the chartered accountants. So that itself says that the previous year figures have to be given. So it is given there. Now, as regarding this, the difference between AS 22 and Ind AS 12, Nilesh, you talked about the balance sheet approach and the other approach which is there. Can you just explain with one of the example with any figure so that the participants are more aware of that?
Yeah, sure. So let's assume in case of balance sheet approach, like we start from the balance sheet, whatever the items are appearing in the balance sheet, and vis-a-vis the balance in the tax base. So for example, property, plant and equipment. So the WDV in our accounting balance sheet or the financial statement is compared with the WDV as per the Income Tax Act. So let's suppose in the financial statement we have WDV or the carrying amount of property, plant and equipment at 100 rupees. Vis-a-vis in the tax base we have WDV of let's say 80 rupees. So there is a mismatch of 20, which is a temporary difference, and we need to recognize the deferred tax liability on that 20 rupees as per the balance sheet approach. In the earlier approach under the accounting standard 22, which says the income statement approach, there we need to compare the items in the profit and loss account. So in case of PPE, we will be having the depreciation in our financial statements. Plus, we will be having depreciation as per our income computation, which is allowed, disallowed in our tax computation. So let's assume we have, let's say, depreciation of 60 rupees as per the financial statement, and we have, let's say, 80 rupees of depreciation as per the income tax or computation as per the income tax. So we will compare both these items. There is a timing difference, and accordingly, we need to create deferred tax on that. Second example would be the provisions. Let's say a company has made a provision for bonus, right? Now, as per the financial statement, let's say the company has made a provision of 100 rupees. Now, provisions under tax is allowed on a payment basis. So accordingly, there will be a zero tax base. So there is a mismatch of 100 rupees. So accordingly, accordingly, deferred tax needs to be created on that 100 rupees. When we come to the P&L approach, let's say during the year, company has created provision for 60 rupees only. So in the financial statement, the expense would be 60 only. And when we compare it with the tax return, zero amount is allowed, right? Then in the profit and loss approach, the deferred tax is created on the 60 amount, on the 60 rupees, because timing difference as per P&L approach is 60. But if we compare it with the balance sheet approach, the temporary difference is 100, right? So this is the fundamental difference between both these approaches.
Great, very well explained. Just one point:
Sure.
is the balance sheet approach allowed under the AS22?
No, AS22 allows income statement approach.
It doesn't allow.
No, sir.
Okay. But the end result is same.
End result will differ, sir.
They're not necessarily.
Sorry.
It's not necessarily same.
Yeah, that's what I'm saying. It may differ on some of the item. It may not.
Conceptually, if
It should not.
Conceptually, if you compare one item where there is, no additional guidance in the Indias, it would match. The balance sheet approach will provide you the overall result till date, while PL approach will provide you the every year impact that will add on, and you will reach to the end result. While if you follow the balance sheet approach, you will directly reach to the end conclusion. What should be the closing balance of DTA or DTR?
So adding on to that, if let's say a company has created deferred tax correctly in all these years as per AS22, then ideally there should not be any difference when they move to Ind AS 12.
Yes.
There might be difference because of few items, for example, revaluation
Fair
is one of
valuation,
those. Yeah.
So coming on to differences at HD, what are book timing difference and tax timing difference? And what is the correlation between the two?
Okay. So before I jump into the timing difference, let's understand few of the basic concept from the AS perspective and from the Ind AS perspective. Though Nilesh highlighted upon some of the aspect, but let me also cover from a broader perspective. If we start to compare a taxable profit and accounting profit, and if we are following accounting standard, which is AS, let's say if we are following AS22, then difference between a taxable income and accounting income, we can classify it into two aspects. One would be the permanent differences and one would be the timing differences. Permanent differences are those which does not reverse. Let's say if you create that, those generate in one period and does not reverse in the subsequent period. Those are the permanent differences. You can say differences, permanent difference, example of permanent differences are those, for example, penalties which are disallowed under income tax straight away. So these are the differences which will not be reversing in future. And if I talk about the timing differences are those differences which has capability to reverse in the subsequent years. If we talk about from the timing difference between books and tax, that might arise due to many things. For example, the cash versus accrual concept under books and tax laws. Under books, you will see the lot of expenses are allowed on accrual basis. Every expense is allowed on accrual basis, I would say. While if you follow tax, few of the expenses are allowed on the payment basis. That is one reason you will see there's a difference between books and tax. Another difference, as Nilesh explained, can be of PPE, where the different methodology, different depreciation rates can be there, though ultimate depreciation amount will be same under both income tax and accounting books, but overall on a period basis, you will see the amount of depreciation is varying. These are the result. There are timing differences, and we do see because of these timing differences, we need to recognize deferred tax. It can be deferred tax asset, it can be deferred tax liability. If I talk about from the perspective of Ind AS, so there is no concept of timing difference under Ind AS. And from the Ind AS perspective, we do talk about the temporary difference. Both, you can say both timing differences and the permanent differences are kind of embedded in the terminology which is called temporary difference. From the Ind AS point of view, what we do, we prepare a financial statement. We already have a financial statement from the financial statement perspective. We also prepare a financial statement from the tax perspective. We do calculate tax base for every asset and every liability. from the tax side, and then we compare tax base of books with tax base as per tax base of asset and liability, which we calculate, and then we calculate the temporary difference and we calculate the deferred tax on the same. So if we are talking about from the perspective of AS 22, you will see concept of timing difference. If we are talking about from the perspective of Ind AS 12, you will see the concept of temporary difference. As we explained, the majority of the side, if there is no conceptual difference like revaluation I mentioned, if conceptual difference is not there, end result you will see the same. Balance sheet approach will provide you the ultimate liability or deferred tax liability or deferred tax asset that should be there at as on date, as on your reporting date, while PL approach or timing approach provides you year on impact, which you add on the current year impact, you add on to the previous year closing number, and you arrive to the closing deferred tax asset or liability under Indian GAAP. I hope it clarifies.
Adeshji, a very, very basic question asked from by Rakesh Bhargavaji. Basically, in case of again non-corporate assets, they say that these assets are providing depreciation as per the Income Tax Act in the books of accounts. So why there would be a deferred tax?
If depreciation is same in the books of account, is same as per the tax laws, then there will not be any difference, and you will see no deferred tax will be recognized in that particular case.
No, here, it is not only about depreciation, na?
Yeah.
There could be 43B, there could be 40A.
Okay. From the depreciation perspective, there will not be any difference.
There may be 43B.
Yeah, you will have to assess all the financial statement line item. You will see that there might be provisions. You will see there might be any provision or trade receivable. So you will have to see all those aspects. And overall, from the overall perspective, yeah, there might be any other line item on which you need to recognize deferred tax asset or liability. And from the PP perspective, the deferred tax asset liability will be zero or will not be required to assess in this particular case.
Just to add out here, in this case, the assessee would not be complying with AS 10.
Yeah.
In AS 16, but in case of non-corporates, they would not be complying with the AS 10 because they are not depreciating over the useful life. So in that case, they'll have to mention in their audit report that it is not a AS, they are not complying with AS 10. So which has to be done invariably for all non-corporates. So everyone has to be very clear. We discussed that in one of the earlier webcast which we had on PPE. So just again, because the question was asked, I just thought that, okay, let us take it again.
Yes, sir.
Sir, may I also ask one clarification? If you permit, Chairman, sir.
Alright, sir. Please, sir.
No, actually, this deferred tax, now if asset, like this is more in terms of the deferred tax asset. Now, if you have unabsorbed depreciation and carry forward losses, that would be taking over for a period of time. In that case, is the company still need to create if there is deferred tax asset? Do we need to do it, or we can still go ahead without making or calculating deferred tax and showing in the financial statement? Because we know in next 8 years, you would never be able to adjust this deferred tax asset. That is just a question which immediately came into my mind.
So, Abhayji, here, if let's say company is probable, there will not be any taxable profit in, let's say, next 8 years. And we know that after within 8 years, the tax laws eventually expire, right? Then I don't think companies need to create any deferred tax. Because under Ind AS 12, it specifically says if there is a probability that there will be sufficient future taxable profit against which that deferred tax asset can be utilized, then only companies required to recognize deferred tax asset. But if we talk about unabsorbed depreciation, that I think can be carried forward to n number of years.
Correct.
Sir, correct me if I am wrong. I am not too fluent. So in that case, company might recognize deferred tax asset, but again, one has to see in how many years company is not anticipating the future taxable profit.
Right. Okay.
And Adeshji, continuing with your previous question, is there really a need to account for income tax, and what benefit does it serve?
Okay. So from the perspective of answering this question, this word income tax cover both income tax and deferred tax. under Ind AS, even if you will see the name of the standard is income tax, but it largely cover guidance of deferred tax. So what income tax itself cover the deferred tax. The question why we need to account for the income tax or deferred tax. So basically we need to consider recognition of deferred tax from the perspective of you would say the accounting concept or the convention which are there, periodicity or matching concept, or from the accrual perspective. The most significant question which arises in relation to taxation is how to allocate the tax expense over the accounting period. Generally, we'll see the recognition of a transaction in financial statement in a particular period is governed by the respective accounting standards. However, the timing of recognition of a transaction under tax law is governed by the applicable tax laws. And you will see there are differences, as I explained earlier. There are differences between recognition of transaction under accounting laws, or I would say tax laws. Because of these differences, you will see there is a mismatch. And let me quote one example. Let's say I have a revenue of rupees 1,000 and associated cost is 900, and I have accounting profit of rupees 100. Let's say my tax rate is 30%. If I do the calculation, if I calculate the provision for tax or current tax, it would be 30 rupees. Let's say in this year, one expenses is disallowed from the tax perspective, and my taxable income is 200. 100 was earlier. Because of disallowance of one particular expense, my taxable income becomes 200, and the total current tax expense in my books will be 60 rupees. So if you will see this year, the accounting profit is 100, while the current tax is 60. Let's move the same situation to the next year. Again, I have a revenue of rupees 1,000 and associated cost of 900, and my accounting and my taxable accounting profit is 100. And if I move to the tax profit, so 100 is there. Let's say the expense which was disallowed to me in the previous year has allowed to me in this year. Now, if you will see this year, my taxable profit would be 0, because expense was disallowed in the previous year, has been allowed to me in this particular current year. So my current tax, because my current profit from the tax perspective is 0, so my current tax would be 0. If you will compare 2 years, so year 1 accounting profit 100 and current tax 60, year 2 accounting profit 100, current tax 0. You will see there is a mismatch. In order to capture these kind of situation, there is a concept of deferred tax. That is why we need to recognize. Let's assume in both the years we recognize deferred tax. What would happen in the year 1? Year 1 tax expense would be 60, but there will be a deferred tax income of 30 rupees. So my net position will be 30 against my accounting profit of 100. And similarly in the year 2, if I do recognize deferred tax, my current tax expense would be 0, but there would be a deferred tax expense of rupees 30. So if you will see, this deferred tax basically clears this accounting and the tax mismatch, and both the years would be streamlined. That is why there is a need to recognize deferred tax.
And should deferred tax
and to be very frank, only then the financial statement would reflect a true and fair view. So that way when we are doing that.
Yes. Yes, sir.
Should deferred tax asset liability be discounted to its present value, Nilesh ji?
So that I will say most of us may not be aware, right? So I tell you, when we started working on these standards, so I thought this may be scoped out of IFRS 9 or Ind AS 109. That's why we are not discounting. But only few months ago, when I read this Ind AS 12, complete Ind AS 12 in a go, then I recognized it is specifically mentioned in Ind AS 12, which says the paragraph 53, if I am not wrong, it says deferred tax assets and liabilities are not required to be discounted at all, right? Yeah. But it does not mention about the current tax, right? So as we have deliberated so far, so I think all the members may be aware we have current tax and deferred tax, right? So Ind AS 12 denies for discounting of deferred tax, but it doesn't mention about the current tax. So there are two arguments, though I have not seen in any of the financial statement, but there are two arguments whether current tax needs to be discounted or not. There can be so one school of thought is since it is a tax payable to or recoverable from the government authorities, and accordingly need not to be discounted. But again, there is second school of thought which says there can be an accounting policy choice and can be discounted. Not relevant for this particular question, but I thought let me just highlight what the exact requirement in India's 12. So India's 12 just talk about non-discounting of deferred tax asset oblique liabilities.
All right. And how and when deferred tax liability can be set off in presentation, or there's any disclosure that we need to disclose it separately? The asset needs to be disclosed separately and the liability needs to be disclosed separately.
Right. So I think we need to split this between the standalone financial statement and the consolidated financial statement. So if we talk about the group financial statements, there are many components like subsidiaries, joint venture and associates, and the parent itself. So if we talk about the standalone financial statements of all these components, then the requirement which India's 12 says, and the same guidance was there in or is still there in AS 22. So it says deferred tax asset and liability can be set off for presentation purpose if the two conditions are met. So first being the entity has legally enforceable right for that set off. And second, these deferred tax asset and liabilities relate to the taxes being levied by the same taxation authority, right? If let's say if we talk about XYZ Limited, so XYZ Limited, when it prepares its financial statements, and eventually when the company or the XYZ Limited wants to calculate its deferred tax asset or liability, what the company will do, I am just reiterating the process which Adesh mentioned in 2-3 questions ago. So they will plot all their items as per the balance sheet, and corresponding to that, the company will plot the tax basis, and eventually they will arrive at the temporary differences, and then the deferred tax. There would be some items which will create deferred tax asset. There would be some items which will create deferred tax liability. Now, for the presentation purpose, which is on the face of the balance sheet or the financial statement or the statement of financial statement, it is allowed to set off or show the net position. If the net position is deferred tax asset or the deferred tax liability, then it is allowed to show only the net position from the presentation perspective in the standalone financial statement, provided two conditions are met. The entity has legally enforceable right, and the tax is being levied by the same jurisdiction or the same taxation authority. So far as disclosure is concerned, the disclosure requirement in India's 12 says that for each type of temporary difference, we need to show what is the amount of deferred tax asset or liability. So netting is not allowed at the disclosure level, but at the presentation level. So this was all about the standalone financial statement. Now let's come to the consolidated financial statement. Now, the requirement of the second requirement, which says the deferred tax asset and liability can be set off against each other if it is levied by the same taxation authority. Now, this requirement is to prohibit the offset of deferred tax asset against the deferred tax liability in the consolidated financial statement, right? Let's suppose if this requirement is not there, then what will happen in a group? If let's say there are 6 components, 3 has deferred tax asset, 3 has deferred tax liability in their standalone financial statement. If this condition is not there, then what will happen at the console level or at the group level? Again, the DTA or deferred tax asset and deferred tax liability will be again net off, right? It means net group tax liability or tax asset will be lesser. So to prohibit this, there is a requirement that deferred tax asset or liability can be set off at the individual entity level, right? Because at the entity level, we have a legal enforceability right. Now, if there are 5 subsidiaries, then we can't say one subsidiary has a liability, second has an asset, and they can set off against each other, because they are both separate legal entity, and we can't say they both has a legal enforceability right against each other, right? So in a console we can't, but in a standalone we can, from a presentation perspective.
All right. What are the disclosure requirements as per Ind AS and AS, Adeshji?
Okay. So disclosure requirement, I'll talk about from the perspective of both, and we'll highlight what disclosure requirement are applicable only to Ind AS. So if I talk about from the perspective of both Ind AS and AS, so we need to disclose the component of tax expenses. It can be the current tax expense, deferred tax expense. It can be taxes for prior period. You will see some of the financial and can see the taxes for prior period item is there. So if any assessment gap was there in any of the previous year and you entity paid some of the tax during the current year, entity will reflect that in the form of taxes for the prior period. Second disclosure requirement is generally in the notes to financial statement, you will see the breakup of deferred tax asset and liability, the component wise breakup. When I say component wise breakup, you will see the deferred tax recognized on PPE, deferred tax recognized on lease transaction, deferred tax recognized on leave encashment, gratuity, deferred tax recognized on section 35D. You will see the component wise the calculation or the component wise breakup in the notes to accounts is required to be provided in both Ind AS and AS. Then you will see, in case if entity has not recognized any DTA, be it on normal transition, be it on unused tax losses, be it on unabsorbed depreciation or any kind of unused MAT credit under Ind AS. If these kind of situation is there and entity has not recognized any DTA, then entity need to disclose the deductible temporary difference. What was the amount at which entity did not recognize DTA? That we need to provide in the financial statement. And in case if entity has recognized any DTA and the explanation of the same, if those DTA are dependent upon the future profit of the entity, it can be due to virtual certainty, which is provided under AS, and it can be because of probability of certain other evidences under Ind AS. If entity has recognized any DTA, then entity need to explain the overall, I would say, the reason or explanation of the evidences why entity has recognized DTA. Then entity also need to disclose if there is any change in tax rate or if there is any change in law post end of reporting period. Then few of the disclosure requirement are straight away coming out from Ind AS 12. One is effective tax reconciliation. So entity need to provide effective tax reconciliation, which basically explain the relationship between tax expense and the accounting profit. So a RICO we provide, let's say if we have accounting profit of rupees 100 and we have a tax rate of 30%, then generally you will see the tax expense should be 30 rupees. But you will see that this situation is not there. Tax expense under the financial, when I'm talking about tax expense, it include both income tax and current tax. Generally you will see 100 profit is there, then should be 30. Be it income tax, be it current tax, but you will see that it is 22 or it is 36. Then you need to provide the RICO of the same. Then why it is higher or why it is lower? It can be higher because of few of the permanent differences. It can be higher because of change in tax law. It can be higher because of you recognize DT in the current year and you didn't recognize any DT in the previous year. So these are some of the example of the reconciliation gap which you need to provide under Ind AS. We do call it effective tax reconciliation. So you see that effective tax in an overall scenario is 30%, but in the financial it can be anything, and you need to provide RICO of the same. Then we also need to provide the disclosure of item which we didn't directly recognize in the PL and we recognize in OCI or equity. Generally, from a layman perspective, you will see the deferred tax entry is deferred tax expense to deferred tax liability. But if you will deep dive into the standard, you will see it's not always deferred tax expense to deferred tax liability. In situation, it can be debit OCI and credit deferred tax liability. It can be debit equity directly and credit deferred tax liability. So overall sense, we do see impact under deferred tax expense. Can be direct impact under OCI. It can be direct impact under equity, depended upon the item on which we are recognizing deferred tax. If item is directly hitting OCI or equity, we do recognize the impact of the same in OCI or equity directly. So these are the broader disclosure requirement, Nikita, from the perspective of AS and Ind AS.
And they both form part of our notes?
Yeah, both form part of our notes to accounts.
Nilesh, should DTA be recognized for timing difference during due to tax holiday?
So, yeah.
And if this has been reversed during the tax holiday period?
Okay. So before starting with this, let me just create a background. What is tax holiday? So what happens sometimes to attract the investment or to develop particular industrial township or particular area, a government announces several schemes. One such scheme is tax holiday, where let's say for initial 5 years or 10 years or 15 years, the taxable profit is not taxed at all, or there may be a reduced rate of tax, right? So eventually tax holidays result in tax reductions irrespective of the taxable profits, right? Now coming on to the requirement of recognizing deferred tax asset in case of timing difference during the tax holiday period. So the guidance laid down in Accounting Standard 22, it says where the deferred tax arises on the timing difference during the tax holiday period, and they eventually reverse during the tax holiday period. So there is no requirement to create deferred tax asset on that, right? Because the company would not be paying any taxes during the tax holiday. But if the timing differences originates in, let's say, tax holiday, but not completely reversed in tax holiday, some left and they will be reversed after the tax holiday is over, then in that case deferred tax has to be created. Now let me just share my screen for the better understanding. I have one example. Let me just know when my screen is visible.
It's visible.
Okay, so let me just, yeah. So let's assume there is a 15 years period which I have considered, and these orange marked years 1 to 10 means the tax holiday. So there is no tax at all for these 10 years, right? Now in column C, I have plotted the profit before depreciation and tax, which is I have considered same constant for all these years. Depreciation as per books is 100 rupees for all these years, and tax depreciation is 375, 281, 211, and so on. Now accounting income after depreciation, so 100 minus 1000 minus 100 comes to 900, and this column G is income as per tax. So I have deducted this tax depreciation in column E out of this C. So this comes out to 625, 719, 789, and so on. Now if you see there is a mismatch. As per accounting books, I have a profit of 900, whereas under income tax 625, and so on. Now the entity is allowed deduction under 80IA for these 10 years. So there will not be any tax for all these 10 years. Taxable income is 0. From 11th year, the company will pay a normal tax. Now here the timing difference is accounting profit minus book profit. Accounting profit minus tax profit. Now this cells marked in pink depicts the origination of timing differences. if you see after this row number 12 or year number 5, these starts reversing. So the total of these pink highlighted cell is 644, right? Now these minus figures from this minus 11 to minus 74 is minus 644. That means all of the timing differences which have originated in these years have reversed from year 6 to 15. Now these blue highlighted cells means the timing difference which has originated in the tax holiday period has reversed in the tax holiday period, right? So out of this 644, 228 timing difference has reversed within the tax holiday period. So there will not be any deferred tax impact on these. 416 is the figure of deferred tax, figure of timing differences which have reversed after the tax holiday period is over, right? So summary is like this: total timing difference is 644. 228 are reversed within the tax holiday period. 416 are reversed after the tax holiday. Now assume the tax rate of 30%, right? Now in the year 1, company has 275 of timing differences. Out of this 275, this 228 will be reversing in the tax holiday itself, right? So there remains a balance of 47. Now out of this 275, 47 timing difference will not reverse within the tax holiday. So company is required to recognize deferred tax liability on this, right? So company has recognized a deferred tax liability at the rate of 30%, right? Accumulated deferred tax liability is 14 only. Current tax will be 0 because company is into the tax holiday. So total expense or total tax expense is 14. Now next, these 4 timing differences, which amounts to 369, will be same. So company need to create deferred tax liability on all these, right? Because these are not reversing within the tax holiday period. And accordingly, the accumulated DTL will keep on increasing. And accordingly, tax expense, right? Now, from year 6 to 10, there will not be any deferred tax impact, additional deferred tax, and there will not be any current tax. So total tax expense will be 0. You can see from these row number 13 to 17, my DTL, accumulated DTL is same because I'm not creating any further DTL in these periods, right? Because we have already reduced our timing difference over here. If you see all these 228 have been reduced from 275, and on the balance only deferred tax liability was created. Now from the year 11, the company will start reducing its deferred tax liability because eventually this deferred tax liability has to be 0, right? Now you can see my deferred tax liability is reduced to 0 in the year 15 because the timing differences which has reversed after the tax holiday, it has impact on my DTL balance. And you can see the tax expense is going up or current tax is going up, right? This is how the tax liability or the deferred tax liability and current tax liability needs to be recognized for the timing differences which are reversing within the tax holiday period or which are reversing after the tax holiday period.
And so then how do we disclose it in the first year or the second year?
Sorry?
How do we disclose it in the first year or the second year?
So in the disclosure which Adesh mentioned, at part of the ETR, it needs to be disclosed the component wherein the company has effect of 80IA or 80IB. And accordingly, a note needs to be given in the end what type of timing differences are there? What are the total timing differences which will reverse within the tax holiday period, which will reverse after the tax holiday period? That has to be disclosed as part of the disclosures.
Okay. All right. Adeshji, what should be the accounting treatment for deferred tax in case of long-term loss with respect to virtual certainty? And how do we check on the same? What about the indexation of capital loss?
Okay. So first of all, I'll let me discuss about the virtual certainty, and then I'll come to the indexation in case of a capital loss. So we do see this word virtual certainty. Let me take you a step back. If we go under AS22, then you will see the virtual certainty is there. When we see virtual certainty, in case if we have deferred tax asset, and let's say if we have unabsorbed losses or unabsorbed depreciation or carry forward tax losses, and our history, past history has been of losses, then generally we do not recognize deferred tax asset. AS22 allow us to recognition of a deferred tax asset only in the case entity has virtual certainty supported by convincing evidence. When AS22 say virtual certainty supported by convincing evidence, very stringent. Someone has to see the binding contracts or the binding profitable contracts for the recognition of deferred tax asset. Even one of the ESE opinion has emphasis on having a binding profitable contract with with a huge penalty of cancellation payable by the defaulting party. If those kind of situation is there, then someone can recognize deferred tax asset under the AS scenario. If you will see the Ind-AS is slightly less stringent or relaxed as compared to AS22. Ind-AS do not talk about the virtual certainty. Ind-AS talks about the probability, which is supported by convincing evidence. I'm not saying that it is easy to recognize DTA under Ind-AS. It is again difficult, but if you compare to AS22, it is relaxed. There can be situation where you recognize DTA under Ind-AS, but it is not allowed under AS22 because of this virtual certainty. Let me put one case. Let's say if there is one startup, and startup is 3 years has passed, and as of now startup is in losses, and the reason of losses are their huge advertisement costs. Generally you will see this in startup, there is advertisement costs involved in the initial years. You see that the startup is has obtained the borrowing and bearing interest cost. Startup has incurred setup costs. Let's say these are the primary reason for not having profit in a startup. Let's say if you at the end of the third year, you are assessing the whether you should recognize deferred tax asset on the tax losses. Then in this case, you will see, let's say if the situation is like this, that this advertisement cost has stabilized and you are not expecting any increase in the advertisement cost, and let's say company has obtained funding from any of the investor and has paid all the borrowings, so you are expecting no interest cost, and you have started to see that company has started to earn profit, though it's initial year, it's the first year, fourth year, let's say the first year for the profit, but you see the trend is there. This year you have profit, you are not going to incur any borrowing cost because you paid all the borrowings. You are not going to incur any significant setup cost or any significant advertisement cost. Then if you prepare your future cash flows, you will see there is a profit. In this situation, you would be able to recognize DTA. You would be able to substantiate to your auditor that, boss, I have profits available, and future years I will be having a profit, and I will be able to utilize the tax losses which I was carrying. While if you come to the AS, you will see there is no binding orders. The business is as such that entity as of now does not have any binding orders which substantiate the profitability. So in these kind of a situation, you will see that Ind-AS is relaxed and you will be able to recognize DTA. You would be able to substantiate to your auditor, while under AS specifically emphasize on having a virtual certainty, which is, you can say, you can only demonstrate in the form of any available future contract with you which substantiate the profitability. The second aspect of the question is indexation in case of a capital loss. So if there is any non-depreciable asset or if there is any investment security on which you are assessing the deferred tax, generally you will see that these assets will be taxable under tax laws in the form of capital gain. So in this case, you will need to, first of all, if this is a situation, then you will be assessing tax base. And when you are assessing tax base, then obviously you will consider the indexation cost. Whenever you are, liable for a capital gain, you consider the indexation cost. So your tax base will be increased from the indexation cost perspective. And further recognition of deferred tax would also be from the rates of long-term capital gain or loss. So in case if company has carry forward capital loss, then recognition of DTA would depend upon the profitability of future capital gain only, because business gain, if you have probability of, you have capital loss available, but you are not having a future visibility of capital gain, then you should not recognize DTA on the same. Because if you have future business gain you will not be able to utilize from the capital loss. So that is why in case you have capital loss available, DTA only recognized when you have a certainty or visibility of the future capital gain, which is a very rare scenario, I would say.
Yeah, it is. And what would be the tax rate at which DTA, DTL should be recognized, Nileshji?
Okay. So, Nikita, standard says like deferred tax assets. The same requirement in AS 22 and in AS 12.
Yes.
Standard says DTA, DTL should be measured at the tax rate which are expected to apply as and when the asset is realized or the liability is settled, right? Or based on the rates which the entity thinks have enacted or substantially enacted by the end of the reporting period. No, for applying the rates or the new rates, substantive enactment should exist at the reporting date. That means if the year end is 31st March, then the new rate should have been enacted by that date. Though there is no sufficient guidance under Ind AS 12, but there was some discussions on this between IASB and IFRIC, though there was no formal formal announcement to that. But the general view is that the substantive enactment occurs when there is no change in that process. So, for example, in India, we usually have our budget session in February, wherein the respective finance minister announced different tax rate for certain class of companies and individuals and other body corporates, right? Which is further approved by both the houses of the parliament. So, if that approval from both the houses of the parliament is before the year end, then we can use that rate. Otherwise, the rate previous to that enactment, right? Because if 31st March the rate has not been or the Finance Act has not been approved by the both the houses and assent of President of India has not been taken, then we can't say it's been substantially enacted by the end of the reporting period. Because standard has used the word rates that have been enacted or substantively enacted by the end of the reporting period.
Yes, that's there for both the AS, Ind AS
right,
and
same.
tax.
Yeah, I would like to add on the same. So allow me, Pramodji. So as Nilesh explained, let's say if you have a tax rate of 30% in this year, let's say the
And
March
next
20.
year it changes.
March 22 is there, you have a tax rate of 30%, and you saw that 1 month back in the February there was a notification, there was announcement of 25%.
There was a proposal that came.
Yeah, there was a proposal of 25% tax rate. From a layman perspective, you will see the deferred tax is reflecting the future taxation. Then you should recognize deferred tax from the 25%. Yeah, but if you follow those standards, says that should be enacted or substantially enacted by the end of the reporting period. When we say the substantially enacted, it means no other authority has power to reject the same.
Yes.
While in the Indian scenario, if you'll say first it goes to Lok Sabha, then Rajya Sabha, then President, then it got notified in the official gazette. Generally, this process take 2-3 months time, and somewhere around May or June, you see that it has been notified in the official gazette. By the end of that period, by the end of that date, you cannot use that 25% as substantially enacted, and we generally carry forward the 30% tax rate only for the deferred tax.
And extending this question again to the long-term capital loss that we discussed in the previous question. So again, the tax rate would differ for long-term and then the normal taxes that we are paying on business profits. So in that case, can we average out the tax, or do we recognize it separately?
We can average out.
No, we do not average out. We do consider separately for each transaction. For the PPE, we will consider the normal tax rate. Let's say if we have any capital gain available, let's say if we were having any land, non-depreciable asset, to which we basically, let's say fair valued. I was having a land of rupees 100. Let's say I was following the fair valuation approach. I revalued the land to, let's say, 200. My book base in this case is 200, while my tax base will be 100 plus any indexation on the same. Let's say if my tax base comes out to 120, so I'll compare 200 with 120. I will recognize the deferred tax liability with the tax rate of capital gain. Let's say the capital gain tax rate is 20%, then on the 80 rupees, I will be recognizing deferred tax with 20%.
So adding on to that, we can average out where we have like a different slab rate for the deferred tax.
For say non-corporate entities where we follow different slab rates.
Correct. We can use that average rate in that case.
And Nileshji, going forward again with this
question. Here, one thing more. Now the scenario has changed as regarding enactment of the law. Earlier it was when the budget was pronounced on 28th February, then the case was different. But now, since the new government, when they are doing on 1st of February, invariably see that by 31st March, it is notified. It becomes an act.
Yes.
Now that is there. Now another case could be where the entity says, okay, now the rates are already there in the law. And they say, today I am going for the turnover based tax rate. Tomorrow I am shifting to 115 BAA, the reduced tax rate. That is allowed. So in that case, there could be the different tax rate which is existing on that date. But now then again, that option is to be taken at the time of filing of the ITR.
Right.
So that complications we have to be very, very careful.
Yeah, which is different at the date of the balance sheet.
So Pramodji, these type of implications will be for the person who will finalize financial statement next year. So suppose company in today today financial statements are finalized considering 30% tax rate, but eventually when they file return, they've opted for, let's say, reduced tax rate. But
no, it happens. Let me give another example.
Yeah.
Today I'm going for 30%, going for 25%, and management says that around the 31st March next year, when we are finalizing, they say, okay, now we'll go for 22%. So you make a provision, everything, have a MR and everything. And by the time of filing of the ITR, they say,
they have changed.
25%.
So
that is enacted law. That is enacted law.
Correct. So this is the same situation has happened to me like just a day or two before. We are auditing one company, right? We have prepared the tax computation, we have finalized the deferred tax asset, liability, and all. And suddenly their tax team comes and they say there's a provision and which we have taken a deduction in tax out of the context. I'm not debating whether that was correct or wrong, but we were not aware they have already taken a tax deduction of a provision based on certain assumptions or certain guidance. And this usually happens in case of companies. They have taken, let's say, one stand when they finalize their financial statement, and eventually change the stand when they file their ITR, and then it is left to the person who eventually finalize their financial statement next year to struggle with all these things.
So, Nileshji, again, extending the same question.
Yep.
Is the company liable to pay it if the company is liable to pay taxes under Section 115 JB or a firm, say, under Section 115 JC? Then what is the tax rate at which DTA, DTL should be recognized at?
Nikita, these like Section 115, these are applicable where the tax is not the provision for tax is not there as per the normal tax rate, right? So we call it as minimum alternate tax, right?
Yeah.
So it is the income tax which is paid on the book profit, right? That means minimum this much amount has to be paid by the company, right? MAT is required if the tax payable as per normal provision is less. But coming on to the deferred tax, right? Deferred tax on the temporary difference has to be created as per the regular tax rate and not as per the MAT rate.
Okay.
Yeah.
Adeshji, in case of amalgamation, if the transferor has not created any deferred tax, looking at the prudence of virtual certainty, then should it be reassessed at the time of amalgamation?
Straightforward answer is yes. Let me go into the details. Generally, you will see the company didn't recognize any DTA as we discussed in the last question because of the virtual certainty or the probability under Ind AS. And company is getting amalgamated into the another entity. And let's say if the transferee is having profits available in their books from which as a transferor I can utilize my losses, I can utilize my unobserved depreciation. If this kind of situation is there, then obviously you will reassess your deferred tax asset recognition criteria and accordingly will account for the same. One important aspect which we need to carefully evaluate that this recognition of deferred tax will not become part of your business combination accounting. Generally, if we are amalgamating into another entity or we are acquiring one entity, let's say if I am acquiring one entity and that has brought forward losses and was not recognizing any DTA, as a acquiree I have profits available, then I will reassess the position of deferred tax asset recognition, but this will become part of my I would say reporting period and requirement, and this recognition of deferred tax asset will not become part of my business combination accounting. So if any business at the time of business I will not go into the deep, but at the time of business combination, if I am recognizing any deferred tax just because of the business combination, let's say I recognize any goodwill or I fair valued any intangible assets, then that the deferred tax that particular deferred tax become part of business combination accounting, and instead of going into the expense, the entire hit goes to goodwill. So yeah, if we keep the question to the basic one, that do we need to reassess at the time of amalgamation if we were not recognizing any DTA? Yes, answer is yes, we need to reassess and accordingly need to recognize DTA or not recognize DTA, whatever the situation may be.
And should deferred tax be considered for the purpose of computing EPS and for declaring dividend?
So when we compute EPS, the base we the consider is the profit after tax.
Yeah.
And when we consider profit after tax, you will see the deferred tax is already captured there. So while we calculate EPS, we consider DTA. One argument why then this is that because DTA substantiate the matching concept or the accrual concept, and which is prevalent, and we need to consider that. So that is why we consider profit after tax while we calculate EPS. Otherwise, you will see a very haywire result across the periods. Therefore, we do capture and consider our EPS calculation. Similarly, declaration of dividend is never becomes a part of your PL statement. Dividend impact is straight away appropriation, P&L appropriation, and straight away hits to your equity. Instead of routing through the PL, you straight away take it to the equity, and therefore that too doesn't become part of your EPS calculation.
Yeah, that's right. And Nileshji, if there is any diminution in the value of current investment, should DTA be recognized in case of a timing difference?
So diminution in the value of investment, it's a timing difference, right? Because eventually there will not be any amount of provision allowed under tax basis, right? So
Yes.
suppose I have an investment of 100 rupees in my financial statements, and accordingly the tax base is also 100. But due to XYZ reason, let's say company has made a provision of 20 rupees in the books. So the accounting base would be 80, whereas the tax base will still remain 100. So that 20 is my timing difference, and accordingly, a deferred tax asset needs to be created on that.
Yeah. And what if there's an upward revaluation of fixed assets? Should DTA be created, Adeshji?
Okay. So in the case of upward revaluation of asset, they are, I mean, you would say gap difference under AS and Ind AS. Under AS 22, we do not deal with this kind of aspect. If there is any revaluation of any of the PPE, then we do not recognize any deferred tax on the revalued part or the revalued portion, you say. While under Ind AS, this upward revaluation of PPE give rise to the book base of an asset, while the tax base of asset will stay intact as the tax, because I mean, you will say the tax base stays intact because the tax deduction will be allowed to the original cost of PP only. One might conclude that revaluation has no tax effect because the depreciation will be allowed to the original cost under the income tax law. However, this is not I mean, I would say the correct analysis under Ind AS, because under Ind AS we focus on not only not only whether the revaluation has directly getting directly taxed, but rather we also focus on the profits that will be subsequently taxed at the time of sale of the particular asset. So under Ind AS, whenever we assess the deferred tax, we consider both the use of the asset and we also consider the subsequent sale which might happen. I mean, though entity business model is that entity is not going to sell off the asset, but still we assume, it's a rebuttable assumption, we assume that tax impact will arise at the time of sale. So revaluation will be having an impact on deferred tax under Ind AS.
And as far as AS 22 is concerned, it's going to have no impact since we are taking the income statement as the base.
Correct.
Yes.
And can a company avoid creating DTL on the ground that it intends to carry major amount of capex program in future? Nilesh ji can answer this.
So straightly the answer is no. Now, why no? So under AS 22, it specifically mentions under the recognition criteria, the deferred tax should be recognized for all the timing differences, subject to the consideration of prudence concept in respect of deferred tax asset. That means we have the concept of prudence wherein deferred tax asset may not be recognized for let's say tax losses or unabsorbed depreciations, but so far as deferred tax liability is concerned, there is no exception or exemption to that. A company needs to recognize deferred tax liability for all the timing differences. When we come to Ind AS 22, same thing is being mentioned in the recognition criteria, wherein deferred tax liability needs to be recognized for all taxable temporary differences. There is some exception which we say initial recognition exception, IRE, wherein the company has exemption from initial recognition of goodwill, then initial recognition of assets or liabilities. Let's say when we are let's say purchasing plant and machinery, right? Now, provided that initial recognition of any asset or liability is not due to the business combination and it does not impact either my accounting profit or my taxation profit. So in example of purchase of plant and machinery, it's not a business combination. Plus, initially when I am recognizing, it will not impact my taxation profit or my business profit. So there is an exception to that. So apart from these, all the cases, deferred tax liability has to be recognized by an entity. There is no exemption from that.
I think the questions as far as we had are more or less through. In case we have any questions from the participants or if there's anything that you feel has been left out and should come to our knowledge, I would request you to kindly share.
Nikita, before that, I just want to like add up A new learning, I would say, which I have got in, let's say, last week, when I was like finalizing the deferred tax workings, what I did, we just took the financial statements, right? We already have the comparative amounts. We just prepared the computation of income and just then calculated deferred tax. We did not give any reading or any. We did not go through the computation which the companies or this particular company had finalized in last year. So there were certain provisions or certain things which in normal it looks whether it will be allowed or disallowed, right? Just like provision I was telling, right? So I was not aware why this company has taken, or before this point, why this company has taken a tax deduction. Because initially, when the word we see provision, the mind says it is disallowed under tax, right? And based on that, we finalized our tax working. But based on certain tax positions or certain guidance, this exemption, this provision was already allowed as tax expense in their return, which was also passed under the assessment. And this is the learning which I took from that instance. Like, first of all, we need to see last year's filed return with the computation, and then we need to start our working from this financial year.
That's a very well taken point, Nilesh.
Reggie, will you take the questions, or do you have the link, or should I ask?
I just have one point to ask Nilesh or Radesh, if you have, just say, when you have, I'm not sure if, you may have covered also in your deliberation, but I thought just to ask once again that in case, when there are change in rates of taxes, the corporate rates, we've seen that there have been changes over the years, like 18, 19, you have a different rate of tax, or maybe now you have a different rate of tax. Now, this impact of deferred tax, or if you had liability earlier, now you have taxes. So this difference of tax, how would that be get adjusted over the years? If you may not have asset, just one asset where there is timing differences, but this impact would continue, or how do we do or take it effect in the financials if we have to? You followed what I asked?
Yeah, so your question is basic. If, let's say, if I have one asset, earlier I was recognizing deferred tax with a rate of 25%. Now it has revised to, let's say, 30% or 35%. How should I take the impact of the same in the financial statement? Is that right?
Correct.
If this kind of a situation is there, then I would say that if we are following the Ind AS, then we do follow the balance sheet approach. Whatever temporary difference we have, we straight away will compare the book based carrying value with the tax based value. Then if you do compare book based carrying value with tax based value, we will be having a temporary difference, and we'll straight away apply the tax rate which is applicable on that particular date. And you will directly reach to the, I would say, the end answer, or the end value of that deferred tax asset or liability. If you were following AS 22 and you were following P&L approach, then there would be two impact. First would be the impact of timing difference of current year with the rate of 30%, which is revised rate. And second, whatever deferred tax you recognized earlier, you will also add onto the same in the form of change in tax rate. And then you will reach to the total liability or asset value, deferred tax liability or asset value at the end of the closing value. And this change in tax rate will become, from the Ind AS perspective, when you prepare the effective tax rate reconciliation, this change in tax rate becomes part of your effective tax RICO.
There will be a separate component.
Yes.
Okay. So each time there is change in, or maybe a few years there is change in tax rate, then this impact has to be
right
given.
Yes.
All right. Okay.
So one question from Mr. H. Iyer, and it could raise so many other issues into this. He says, he asked that as per the new provisions, In case of trust society, etc., expenses are now allowed only on cash basis. How the adjustments are to be made if the organization is following mercantile basis. Also, how the TDs is to be claimed in case tax is deducted, but interest is not actually received by the trust. Bank is crediting the interest only on maturity of the deposit. Without kindly elaborate.
So I think when we are saying the in tax, the income is taxable on cash basis,
No,
right?
expense.
Expenses, sorry, yeah, expenses are allowed on a cash basis, but eventually under the Companies Act, I would say, or let's say when the financial statements are prepared, it is on the accrual basis, right?
It is a non-corporate, no? It is a trust.
Non-corporate. Okay. So there is no other standards in that case, right? So it's only the tax which are allowed on the cash basis expenses. So how do we compare the tax base with this? So I would say accounting base is 0.
Now here, few interesting facts which I understand. Point number 1, in case of these trusts, these are their income is exempt under Section 12A.
Right.
Now there could be a case where they are not having any business income. In case they are not having any commercial income, I would say, I will use the word commercial income, then the accounting standards per se are not applicable. Right? Because they need to have some commercial activity. But suppose they are having some commercial activity also. Now the question would come. So now here the question would come because they have to comply with accounting standards. So when they are complying with accounting standards, here the same thing which 43 would be coming into play.
Correct.
That in the books it is there, but under
tax
income
0. Yeah.
But here again, because there is a condition that they have to spend up to 85%. Now suppose they don't spend 85%, then what happens is that on the excess, that on the excess they have to pay tax. And
Right.
tax is at the maximum marginal rate, which goes to 37-38%. Right. So all those complications, seeing that whether it would be, they would be paying tax, they would not spending 85%. In that case, there would be a timing difference in the case of that accrued expenses.
Right.
Which are not paid. So as discussed in the whole session today, accordingly it should be taken.
So need to consider all the aspects, that 85% and adhering to the accounting standards, business income is there or not.
This question, Delvendra Singh ji's question is, when physical delivery of shares is received in case of options, at which rate shares should be recorded in the books? Strike price or the value as at the close of the expiry? I suppose this is not in relation to income tax, but whatever is the cost which the assessee is incurring at that cost. It is the strike price plus the actual amount which he has to pay. Both. Mr. Y.K. Maghan's question is this: should disputed tax liability in the first appeal be provided for even if it is covered in favor of the assessee by the High Court?
I think that depends on the probability analysis of the management, what the management's course of action, whether they are going into further appeal or not. That depends. That's a judgment from the management's estimate. I would say there is no accounting standard which tell you whether to show this as a contingent liability or not.
No, here again I would say this. AS22 would not be applicable, but right. AS29 would be applicable.
Or Ind AS 37.
Whether it is or Ind AS 27, whether it is a provision or a contingent liability.
Correct. But so again, Ind AS 37 or AS29 would provide the definition. But eventually, what I would think is it's the management judgment based on all the parameters and what is the course of action in future from the management side, that would ultimately decide whether to show or not to show as a contingent liability.
Again, yes,
And at what amount?
very rightly said that you have to just think about the management will have to decide upon whether it is a contingent or a provision is required.
Right.
The probability of future outflow. So if they say the High Court judgment is in favor, they are positive, then it would remain contingent. So again, it is not related to my AS 22 or AS 12, but it is related to the another standard. This question you might be seeing at various times by the auditing finalization of the financial statements. Amit Sarabji's question is whether provision for income tax is required to be adjusted with advance tax TDS in the notes even before the completion of the assessment. So how do you account for?
So see, basically provision for tax for the current year, we capture into the current portion. If you do have any other advances available, be it for the previous year, and if let's say if I have paid any kind of advance tax or any TDS recoverable I have pertaining to the current year, the provision for tax in the financial statement I will net off and present the ultimate liability which I am going to pay in the form of current tax. While if I have advances available or if I have paid in excess in the previous year, that will be non-current and will be reflected separately from the current year's figure.
Very rightly said. Very rightly said. Arun Kumar Srivastaji's question is, what is the objective of balance sheet approach?
Objective of balance sheet approach. So that under the profit and loss approach, I think there were certain items which were not getting captured, like which were directly hitting in my reserves. Now we can capture all the items over there. Better approach, I would say. Otherwise, as we already deliberated, if a company has created deferred tax in all the previous years correctly, then I don't think there is any difference. But yes, approach is different only.
Okay. This question is from Amit Sarabji. Provision for gratuity which is made as per actuarial valuation report is allowable expenditure as per judicial pronouncements. However, if the assessee wants to claim the expenditure of gratuity in the year in which actual amount is paid, then provision for DTA needs to be created. Please confirm.
Yes, absolutely right. Under the accounting books, we create provision for gratuity as per the actuarial valuation. POC method we apply and we calculate the expense as per the actuarial report. And while under income tax, it is allowed on the cash basis. You will see because of accrual cash mismatch, you will see the accounting profit would be different from the tax profit, and you need to recognize DT on the same.
Very right, Adeshji. But Amitji, just to inform you, Amitji said is very right. But the thought that making a provision as per actuarial report is an allowable expenditure under income tax, that is not correct.
No, okay.
That's not correct.
Yeah.
Only if it is to an
payment basis.
If it is to an approved gratuity fund.
Gratuity trust.
In that case, it is allowable where it is to pay to the approved gratuity fund to that extent. Otherwise, it is not allowed. This question for the purpose of valuation of shares. Arun Kumar Srivastav says for the valuation of company, whether deferred tax asset liability should be considered for arriving at valuation.
So we are saying that we have an unquoted investment and we are fair valuing the same. Is it right?
Yes.
So let's say if we have unquoted investment, let's say I have investment in share for any of the unlisted company. As per the standard requirement, I need to fair value the same. And let's say I acquired the investment at rupees 1 lakh and fair value of the same, let's say, is 120. Then you would say my book base has increased and my book base has become 1,20,000. While you need to assess your tax base will stay as it is as 1 lakh. If it is long term in nature, then you will obviously apply the indexation impact. and whatever your tax base arises, be it 1 lakh or the amount after the indexation impact, will become your tax base. The difference between two, let's say 20,000, is your deductible temporary difference, not so is your taxable temporary difference, and you will recognize deferred tax liability on the same with the applicable tax rate, which in this case will be the long-term or short-term capital gain tax rate as per the management assessment.
Great. Amitji's another question is interesting question. This deferred tax asset or liability, which relates to an earlier error because it was not accounted for. Now it is to be accounted for. So is it to be adjusted with the opening balance of the profit loss account or need to be accounted for the current year profit loss account? Please answer this not in terms of Ind AS but AS.
So if I understood the question correctly, so DTA was not recognized. The question is that both either DTA or DTL was not recognized in the earlier year. In a normal scenario, DTL, not recognition of DTL situation will not be there. So I will consider DTA situation. DTA was.
No, please take that this standard was not considered.
Okay.
Now
So there was one item for which DTL was not recognized.
So if any DTL was not recognized, you will take the impact of the same in the current year. If you are showing it as an error, then you will need to revise your financial statement. You will capture it into your comparative period. You will restate your financial, and accordingly you will take the impact. If you are saying it is an error, if it was change in your estimate, let's say DTA was not recognized because of change in estimate, then that will hit your current year.
So Adesh, for DTL, I don't think there is a choice. Company has to show this as an error, right?
Yeah, that I mentioned the start only.
Right.
DTL
yes, for DTA there can be a change in estimate, but for DTL cannot.
Yeah, if entity didn't recognize an DTA and amount
DTL.
is material, DTL and amount is material, then you will have to restate your previous year figures.
No, previous year results now it cannot be done through. It is not that
From
simple.
opening.
From the opening.
Yeah.
Yes.
From the opening you have to do. Okay. Arun Panpalia ji's question is, if we have to rectify previous year figure, there would have to have a changed deferred tax in Ind AS. And what is the treatment of the same in the case of AS?
Sorry, come again.
Question is, if we have to rectify previous year figure, there would have to be a change deferred tax in the Ind AS, and what is the treatment for the same in the case of accounting standard?
I think this is the same question which we discussed just now. From the opening balances, right, Adesh?
If it is an error.
I think he wants to say that you assessed it on the balance sheet basis. Do you need to do anything on the PL basis also?
No. It's now under Ind AS only the balance sheet approach. But there is a reference of accounting standard also. That's what I am confusing.
Yeah, AS20 is going on to AS22.
Right,
so that's
right,
why
right.
I'm saying, is it meant to be with the PNL also?
No,
Or
so if we are following Ind AS, then balance sheet approach. If we are following accounting standard, then just the P&L approach.
Another question is interest under the income tax interest under section 234 ABC has to be accounted under the head finance cost and should not be merged with the provision for income tax. So please provide the relevant para of accounting standard which provides such statement.
Error is not straight away, I mean, we know as of now, but yeah, this is the right practice that interest under section 234 ABC should become part of your finance cost, and you should not treat it as an income tax itself. In earlier practice, you will see people were considering section 234 ABC interest in the form of taxation only. That is not a right practice to follow. You should consider it as a finance cost.
Under income tax, interest on income tax is part of income tax. But for the financial books, as per Schedule 3, as per my general accounting principles, it is not the accounting standard. It is general accounting principle that anything which relates to the finance based upon the interest charge, that should be a part of finance cost.
Thanks, sir. Thanks for clarification.
Adarsh Rajji's question is, in case a parent entity is having a branch office outside India, Can we club the DTA DTL while preparing the financials of the Indian company?
Okay, so entity is having a branch outside India. Branch I would say is is extension of one of the company itself. It doesn't have any legal ownership or legal entity. So yeah, you will have to consider the deferred tax impact of that particular branch from an overall company perspective instead of treating it separately. Is it just an extension of your company?
And in case it is a separate entity, then it was deliberated that with the consolidated and the separate legal entity.
Okay, Bhargavaji's question is because you explained that through the PPT, the calculations. So he said that kindly explain your calculations are based on projections or what?
Yes, these are based on. So okay, so there's tax holiday, right?
Yeah.
So in case of like tax holiday, the depreciations would be like fixed, I would say. There are no projections. As per Companies Act, I will, let's say, depreciate over a useful life of 15 years. So my depreciation will remain same for all these 15 years. Under Income Tax Act, let's say my depreciation rate is 25%. So that depreciation rate, I know today what will be my depreciation rate going forward, assuming there are no additions and deletions, obviously.
Yeah.
So Nilesh, computation was carrying the profit figure for all the remaining 10 years.
Yeah, that is estimated figure.
Yeah,
that is constant. Yeah.
This question is from Timal Maruji and similar is from Rakesh Bhargavaji. Timalji has given an example. We had discussed that during our deliberations. But as on 31st March 22, the company is having tax rate of 25%. Now in the subsequent year, the company opts to go for the lower tax rate, that is 22%. Whether in such case, deferred tax as on 31st March 22 should be 22% or 25%. That is a future rate or the current rate.
So, yeah, go ahead.
So, I mean, as on the reporting date, company today is following the 25% and from the future 22%. And again, I would say we'll have to see the enactment of the rate. When company is saying company,
it is in the law. It is in the law itself.
Then you will have to consider 22% for the deferred tax creation.
Isha Handaji's question is, what is the position of deferred tax in case of prior period items?
Interesting.
Okay. So, I mean, I do not have any straightaway answer. Sir, if you have, then you can
I think
deliberate on the same. But from the financial will become part of your, from the financial standpoint will become part of your restated financial. You will revise your previous year financial statement, and which I believe that you need to revise your income tax computation of the previous year and need to take impact of the same.
If I practically talk about, there would be no timing difference. Because,
because it's not allowed.
Correct.
Even the prior period expenses are not allowed.
Right.
And you did not claim in that year, so there would be no impact there.
So zero timing difference, no deferred tax.
In case if we have any prior period income, sir,
वो नहीं होगा.
Prior period there is no timing difference. I am paying tax this year, booking this year.
You have to pay taxes.
Both these items.
Okay.
Sai Gopiji's question is, sir, DTA or DTL is to be created as per normal tax rate or MAT rate? MAT rate is also there, 15% now.
15 point something, yeah. So DTA DTL has to be recognized as per the normal provisions of income tax. If a company is paying MAT in 1 year, then the deferred tax needs to be recorded only at the normal provisions and not the MAT.
Not the MAT. Now, suppose the company is saying that, okay, I'll be always be paying MAT because I've got so many of the tax losses.
Then also.
Irrespective of fact, company will follow the current tax rate instead of MAT.
If the company is so sure about its losses that it's going to be there, then what about virtual certainty?
then we need to see all the earlier calculations.
No, DTL will always be there. Virtual certainty will stop you from creating DT only.
But DTL has to be created, yeah. 43B is there.
Great. Megaji's question is, does revaluation of asset retirement obligations calls for recognition of DTA or DTL?
Revaluation of asset of retirement obligation.
Yeah.
I
In
mean,
a non-corporate entity.
It could be both.
This will impact, I would say, if I go by the actuary, this would impact my actuarial valuation, and I will be getting a provision as per the actuarial report, and then again we'll compare it with the tax base, which will be allowed on the cash basis, and we will be having a DTA in a nutshell.
Malaida Lakshmiji's question is, what is the reason to create DTA DTL at the normal rates applicable instead of MAT in case tax on adjusted book profit is more than tax as per profit under the normal provisions?
Because see, provision says at what tax rate the DTA DTL should be recognized, and the standard says the tax rates that have been enacted or substantively enacted by the end of reporting period, right? Now, normal tax provision is, let's say, 25 or 30%. Why a company is paying MAT is because of the book profits, right? But in next year there may be sufficient profit, and company would be paying again the normal tax provisions or tax rate, but the normal provisions. So I think that's the background why the DTA DTL should be recognized as per the normal tax provisions.
Okay, this question is from Aditya Pulivarti. In case asset first increased and after some time it is decreased, then treatment for accounting under Ind AS 12.
Sorry, if you can repeat the question again.
In case asset is first increased, I suppose it should be in the case of
1 year it is increased.
Revaluation. 1 year increased, second year decreased, later year decreased, then the accounting treatment for the deferred tax.
Then, as I mentioning from the start, you will be comparing your book base with the tax base. In this case, let's say you bought an asset for ₹100. Your tax base at the date of purchase of the asset is again 100. Let's say let's assume that you have a same depreciation rate both on the income tax and accounting books. Now you revalue this asset, let's say, to 150. Then you will see, let's say you depreciated for the 1 year, depreciation is ₹10. From 90, you revalued it to 150. Your tax base become 150 while your book base become 150 while your tax base stays as 90. Then you will see there is a difference of ₹60, and you will be recognizing a deferred tax liability on the same. Subsequently, in the next year, again ₹10 depreciation, let's assume. Now you have revalued again. There is a downward revaluation, and the asset value becomes 50 straight away from 150 to 50. Then your book base become 150, 50 in this case, and you will compare it with the tax base, which let's say in the second year is 80, and then you will see there is a DTA. So you will be reversing the impact of revaluation will be there on your deferred tax hit for the PL for the particular year.
Thank you. This question is from Nandlal Duteja ji. Kindly explain the recognition of DTA DTL at the time of first time implementation of Ind AS.
At first time implementation of Ind AS 12, when the companies adopted Ind AS, right?
Yeah.
So at that time, there was, as we earlier mentioned, if let's say company has created a deferred tax asset and liabilities correctly in all the previous years based on the profit and loss approach, then there could not be any difference on the transition date. However, if the company has calculated deferred tax asset or liability as per Ind AS 12 on the transition date, and there was any impact, then that has to be adjusted to the retained earnings on the transition date.
Yeah, I would like to add on this. I mean, if on transition, if we have any impact of deferred tax because of from local GAAP to Ind AS, So that transition impact and the impact for the previous year, we basically need to combine, and this additional deferred tax we will have to basically the capture in the calculation of MAT from for a period of 5 years. The
5 years.
one fifth impact we will capture into
That
the
fair value.
yes into the financial statement for the continuous period of 5 years.
So isn't it as simple as just reassessing the figures?
Yes, from the India's
Just like
perspective,
that. Yep.
yes, but yeah, there might be few additional line items on which you will have to assess the deferred tax. For example, the land. In the case of land, you were not supposed to recognize any deferred tax. While under India's, you will reevaluate if you need to recognize any deferred tax on land. Generally, you will see under India's, you will not see any deferred tax on the land, because land, if land is not revalued, if land is revalued, then you can see. If land generally is not revalued, book base will always be the original cost, while tax base will be increasing with the indexation cost. And you will see DTA situation is there. DTA, that too in the form of long-term capital losses. That is why we do not recognize DTA on the land, and you do not generally see. But from the India standpoint of view, you need to assess. Let's say if companies on a revaluation model, if companies are revaluing its PPE, including land, at the end of every reporting period, then you will say the revalued value of PPE or the land, the revalued value of land will be higher than the indexed cost of land. In that case, you will see the deferred tax impact on the land. So few items can be there. For example, one is land, for example, revaluation of any other PPE. These can be the additional point or the additional component on which you will recognize deferred tax under India's, and might be different from your current position under AS.
Plus, there could be assets held for sale. Since it did not move to the P&L, and accordingly the deferred tax was not created under the income statement approach, and now we are creating under balance sheet approach.
Yeah, that's right.
Yeah.
Great, thank you. Another question from Meghaji is that does the foreign exchange conversion, the change, does that call for the deferred tax?
Yes. So if the company has, let's say, change in the functional currency, right? So under accounting standard, there was no concept of functional currency, and accordingly there was no deferred tax impact on that. Let's say a company has a functional currency of USD instead of INR. So accordingly, the company would be required to change all the balance sheet items as per the changed functional currency, and accordingly there will be an impact on the tax base. So that difference will be temporary, and accordingly deferred tax has to be created on that.
No, maybe she's talking more about the, I would say, AS 11 out here, where at the end of the year, say they are debtors and creditors, and they are converting.
Yeah, they have to be restated.
Restated. So again, that's a temporary difference, I would say.
That would be a temporary difference. Yeah, very fine. Sangeeta Kumarji's question is how to make quarterly tax provisions in the books.
Maybe 1/4.
How convenient.
So generally when we started our articleship, when the companies were required to do the quarterly reporting, so what generally they used to do that for the provision for employee benefits, just 1/4 of the last year's balance, right? Yeah. So for quarterly provision for tax, I think same principles needs to be applied as we apply at the year end, right? To arrive at the
specific
provision.
methodology is provided
Right.
under India's 34 and 10 period. You need to calculate the effective tax rate for a quarterly financial statement. You need to basically, you are at one situation, you extrapolate your income tax, your income cost, you calculate effective tax rate, you apply that effective tax rate to your current year income, and you recognize the provision for tax accordingly.
But it's not only till the tax rate. You also need to see the actuarial provisions, the other.
Yeah, all the remaining adjustment. Yeah, you will capture, as Nilesh mentioned. Generally, for the convenience, we capture we pick the last year figure and we take the 1/4 impact if it is first
But again,
quarter.
depends how robust is our internal control in corporate
Yes,
governance.
exactly. And how
so
we
there
are
right.
doing our bookkeeping and
Correct.
how do we recognize all our expenses?
Right. So there are like numerous practices being followed.
We are just coming to the conclusion. There are questions left, but just taking the last one out here. This is from Jayesh Ganatra. How is MAT credit accounted under NDS?
So under India's, generally you will see the MAT credit. Under the AS, you will see it under the long-term loans and advances, MAT credit. While under India's, MAT credit will become part of your deferred tax. So the DTA, the component of deferred tax asset, whatever you will show, the MAT credit is one of those. And yeah, in nutshell, I would say it becomes part of your DTA. And if you see the AS, you will see it under loans and advances.
I think this is part of ETR also, right? Or no?
It depends on yeah. If you are utilizing your tax credit, MAT credit during the current year, then that will become part of your ETR calculation. If you are utilizing any portion, right?
Great. Thank you very much. Had a great discussion on the panel, and nearly 2,000 participants have witnessed this. And both Adeshji and Nileshji has done a wonderful job. Nitika, of course, has moderated it extremely well. And our vice chairman had to leave in between. He had some urgent work, so he just called me. So thanks to him too, and also to CA Shalini Jindal from the ASB, who has done a wonderful job in arranging all the this whole webinar out there. And also the support, I thank to the tech support out here. Thanks a lot to each and every participant who has been here, witnessing this great discussion which we had in a very casual way, which is really, it makes it very interesting to hear. So thanks a lot. Nitika, just conclude accordingly.
Thank you so much, Pramod sir.
Thank you, sir.
Thank you, sir. Thanks for all your valuable inputs.
It was
it was very helpful.
It was a wonderful deliberation by both of them. They were crisp, to the point, no stories here and there, and I guess one could actually relate to what they were saying. Thank you so much for sparing your precious time, Nilesh and Adesh.
Thank you so much, Nikita.
Pleasure being the moderator for the session.
Thank you, sir, for the wonderful opportunity. Thank you all the participants. Thanks, Nitika.
Thank you, everyone.
Thank you, sir.
Thank you.